thank you to GCM Grosvenor and Resolute Investment Managers Inc. for sponsoring Series 3 of 2025. GCM Grosvenor is a global alternative asset management firm with a long-standing commitment to supporting small, emerging and diverse investment managers. For over 30 years, the firm has developed expertise in funding and guiding these managers as part of its broader activity across alternative investments. With over 20 billion in assets under management dedicated to small and emerging managers and 16 billion in assets under management dedicated to diverse managers, GCM Grosvenor leverages its experienced team, broad network and proprietary sourcing capabilities to support their success. Through the Small, Emerging and Diverse Manager Programme, the firm creates opportunities for investors to access a wide range of talent while seeking to drive strong returns and impact. Resolute Investment Managers Inc. is a diversified multi-affiliate asset management platform that partners with over 30 best-in-class affiliated and independent investment managers. Its unique platform delivers strategic value through a full suite of distribution, operational and administrative services available to affiliates and partners.
I talk about myself as being defined by 3 M's. I'm a mom, I'm a mathematician, and I love mountains. And if you know these 3 things, then you know everything there's to know about me.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast committed to revealing the richness and diversity of the world of investment by focusing on its people and their stories. I'm joined today by Artemiza Woodgate, who is founding partner at Integrated Quantitative Investments LLC based in Seattle. She spent most of her career in the quantitative investment arena, including close to 5 years with Numeric, Man Group, and over 11 years with Russell Investments. Welcome, Artemiza. Thanks for joining me today.
Thank you so much for having me. It's a pleasure being here.
Well, let's start with your background. Can you talk us through where you grew up, what you studied, your early interests, and how you came to ultimately enter investing in finance?
Yes, of course, I'd love to. So I talk about myself as being defined by 3 M's. I'm a mom, I'm a mathematician, and I love mountains. And if you know these 3 things, then you know everything there's to know about me. Just joking. So I actually grew up in Romania, in communist Romania, way back when. And then immigrated with my parents, a number of different countries, but settled in New Zealand, where I went and did my undergraduate honors in mathematics. And then I added another master's also in mathematics before applying to come to do a PhD in finance at the University of Washington in Seattle. So I've been a mathematician. I always loved mathematics, I guess. But one day I listened to this really interesting presentation on the Black-Scholes formula. And I just got hooked on mathematical finance. One thing led to another, and I did my master's dissertation within the math department, but actually did it on interest rate targeting, which basically meant creating a mathematical model, trying to understand how the timing of the rate changes, what happens, so trying to model that. That was really interesting. And then the next thing was I came to Seattle. My husband got a job at Microsoft, so both of us could, relocate. And that was then the PhD that followed in finance, asset pricing. After that, I stayed in Seattle again, having a family and being able to stay here with my husband employed and me being able to work. I ended up at Russell Investments. From Russell Investments, went to Numeric. And now here I am, my own firm, co-founded the firm.
Well, we'll certainly dig into that, the founder's journey and a little bit of, the experience of that so far and what you're focused on today. But before then, I'd love to talk a little bit about your PhD, because I think that is something that most definitely not just sort of a creature of its time. I'm sure the learnings are applicable today. And let's just go through what it was about. It's about asset pricing, specifically the relation between earnings management and price momentum. And you wrote about estimation error, portfolio construction, and some other topics. Can you just reveal the insights that came to you through that process and some of the conclusions and whether you use them today?
Right. Having to deal with noise and noisy signals is basically critical in finance. And that's where the work around estimation error just honed that in nice, right early on. Whenever we think about portfolio optimization, as quants, or if you think about the bread and butter, the key textbook portfolio optimization tools, you think about mean variance optimization, Markowitz framework. Well, that is basically also known as error maximization. So I had done quite a bit of work on trying to understand how to minimize this error maximization, how to adjust for estimation error. Having learned, having gone through that work, and there's a ton of literature out there that of a lot of people who are working on that problem basically learned that it's very difficult to do. So you have to think outside the box. So what we do here is we think about many different models, many different options beyond just your error maximization, mean variance optimization framework to try and think of to put together a risk-adjusted portfolio from portfolio construction. As far as thinking about signals, again, trying to connect to different fields, whether it's earnings management, price momentum, you have so many different signals that are available, and just trying to understand what is it that moves markets, what is it that's relevant, how things are being reflected in the investor's perspective. Again, it's a very difficult task, and the thing that you realize is there's tremendous amount of information out there. There are tremendous amount of signals, and what is critical is not just having access to the data. Nowadays, pretty much everybody has access to the data, the hundreds, thousands of signals, but understanding what is relevant and how to make them relevant. So those learnings that basically have carried on with me throughout my entire career, you come across these issues over and over and over again, and everybody does. And so part of our mission here was to figure out our way, I guess, to resolve these issues and provide something to the clients that is a high alpha proposition.
And it's interesting, obviously a PhD, you were probably looking back at a lot of historic information. Would you say that anything has fundamentally changed in terms of the factors that drive asset pricing? We know that momentum, for example, until we're recording this early April, we've definitely had a reversal of sorts, but we know that momentum was driving a lot of pricing in the recent months, say, at least in 2024. Anything that you think has become redundant, that no longer works, or is starting to play a larger role? Like, are these things static, or are they very dynamic?
Very dynamic. And also what's important is that the risks are dynamic. So if you think about what changes in the market a lot is, the risk pricing for various factors, various pieces of information. It's interesting when you talk about like factors being relevant or not, and you reference the momentum driving the market and then having a reversion and whatnot. I remember one of the worst momentum days, more recently, the 4 standard deviation momentum days. And if you look at it, it was just a couple of stocks, well, a couple of stocks, maybe beyond that, but it was NVIDIA, your main, Magnificent Seven reverting. So it's not actually just some magic momentum, some magic factor reversion. When you talk about quant investing, you have to step back and try and remember you are buying still stocks and businesses, and there are fundamentals that change, and there are business dynamics that change, and there are pricings of risk that is not about some black boxy, distant factor that we label magic momentum. It's actually about a friggin' company where there are significant issues with their earnings stream, with their revenue stream, and that then impacts, the markets and everything else. It happens to be, screening well in one factor or another. But it's not really about the factor. It's about the company, or it's about the industry. It's about whether it's your energy or your banking or your biotechs, whatever it is. It's really about those fundamentals. So thinking about that is just, things have not changed. History rhymes, even if it does not repeat. Hopefully it doesn't repeat. Some history we just don't want to repeat. But the rhyming helps us understand how to deal with these changes, how to navigate these dynamic, risk adjustments. And again, to me, it's about first principles, taking a step back and thinking about what is it that drives these markets and what is it that I want to model, and how do I lower that noise to signal ratio so I increase the signal, and how do I measure the risk in the signal and have that appropriately reflected in the portfolio. The how to do that, the process, we take that, very seriously. We really think about it from a design perspective, how to design that rather than immediately jump in and say, well, this person using this signal, or, I read this paper about this other little data source, or, you have data providers that come and sell you the latest and the greatest and the, the bling in the market. And you realize, well, wait a second, why does it make sense? Why should it make sense? How does it fit into the big picture? And how can I identify the relevancy of whatever it is that they're selling?
Well, let's take that integrated quantitative investments. I guess you took the approach of letting it say, do what it says on the tin, putting on the tin what you do. Can you give us a little bit of an insight into what your strategy is? You've spoken a bit about fundamentals here and clearly
Mhm,
quantitative. Sometimes we don't think of those as being integrated, fundamentals with
mhm.
quantitative strategies. What your approach is and how it's evolved since, say, Numeric.
So it evolved quite a bit. There are many kind of realizations that we had throughout our careers, I guess, at IQI. One was about this relevancy that I keep coming back to over and over and over again. You have new pieces of data, you have new information, identifying what's relevant from a predictive perspective, because again, we're quants. What we know is essentially statistical prediction, for better or for worse. That's our crystal ball. But thinking about how to model that relevancy is critical. And that is very different to, I think, how other quants are doing it. That leads to more dynamic weights, more adjusting weights, that leads to identifying, thinking about more like the KPI perspective of a business, still from a quantitative perspective, but really thinking about, drivers of whatever it is and predictors of return. The second way that we're very different is in really integrating risk and alpha, really thinking about the riskiness in the alphas that we take and thinking about that integrated adaptive risk throughout different market environments. Again, that's where a lot of the work around the estimation error, the noise comes in. How do you identify the risks and how to risk adjust your portfolio? Because at the end of the day, our goal here is to create a high conviction, high alpha portfolio, still risk adjusted. And again, high conviction is not going to be a 20 stock fundamental portfolio, more, 100, let's say, but it's a lot more concentrated than your 500 stock, 1,000 stock, smart beta provider, because we really care about that high alpha to provide that to the clients. There are many moving pieces that come into that. Again, that model design is critical. And it was very helpful, the fact that we could start from a blank sheet of paper and think about, okay, what is it? How do different pieces interact? How does your data integrate with your risk model, integrate with different perspectives, whether it's at the group level, so the country dynamics, industry dynamics, sector dynamics, to a bottom-up stock level dynamics. How does that integrate with different risks in the market? So being able to integrate that from a design perspective from get-go really allows us to be very different to some of the standard quants out there.
And can you paint a picture of two things? One is the environment for quant investing as a whole. And then we'll talk about your experience, fundraising, not the easiest thing to do when you're not, with man groups, say Umbrella, but, clearly you've succeeded. So, how that went. But maybe just firstly, where are we in the spectrum maybe of quant investing today? What share does it represent? Do we have a lot of the carcasses of failed funds that maybe failed in '07 and are still there polluting the environment?
Yeah, that's a good question. Again, you see a lot of new models that have come up and they've been around. I mean, new models have existed for a while, but AI was the craze for years, right? Machine learning, and we're heavy users of certain techniques as well. But it's really important that you understand what it is that you use and how it fits. Again, just throwing everything into some big sausage machine, a black box, and hoping that whatever comes out at the end will somehow magically work. Maybe when the tide comes in and lifts up all boats, that can work. When the tide comes out, you see who has the clothes on and who doesn't. So that's been to us, even if all these tools come out, all this, the latest and greatest AI models and new data sets come in all the time, it's great, fantastic. We can evaluate them, we can look at them, but it's really important that we understand why they should work ex ante. So we have that hypothesis really well defined. I'm not sure that carcasses can last around for a long time. I'm not sure that we have moved on from your smart beta, your large portfolios with a lot of dead capital in them. They're still around because they can raise assets. It's comfortable. You see some large firm that has been around, has a great sales guy, and why not? Why not stay there? That is a bit of an issue, I guess, for new entrants as well, where we think we have a better investment proposition. We think we have a better portfolio, but there is that desire, that drift to go towards the safe, low return in some ways, or low active return, right, providers, just because we're still dealing with people, I guess, who have to make a career decision, not just an investment decision. And the career decision, career risk minimizing decision is to go into the safety. It is what it is. Ultimately, there's stupid people around who don't believe the earth is round.
It's very true. There are many kind of variations of that extreme thinking. But just getting back then to your experience, what you mentioned, I think this, big brand and the kind of the ease of fundraising, or relative ease. It's never easy, but I think relative ease. How would you say when it comes to quant investing, in terms of the barriers to entry, say the investment needed in the tech stack, the need to stay current, the AI, how much of that is changing matters and requires investment? So, and as a startup fund, when you started, how did you navigate that, and what's your experience been of raising that fund?
Yeah, I mean, of course, people say, how do you compete with the firms that have 200 PhDs? And someone actually gave me a really good way to answer that. And my answer was like, well, they have, 197 too many. We have 3 PhDs on the team now. So, sure. If I look at our performance since inception, we basically trounce all the, those 197 too many PhDs. But to me, it's still about how you invest. The model and the investment proposition, the investment philosophy is going to be a driver of returns. Again, if people prefer the risk of the large firms and prefer to tick a box, that is a non-investment decision in many ways. It is a difficult market to navigate just because there are, I guess, a lot of firms out there, but also a lot of asset allocators. They do not wish to be the first one in. They meet with you saying, yeah, this is great, very interesting, wonderful. Here's the next hurdle. The first hurdle used to be SEC registered. You tick that box. Oh no, well now it's 100 million. Well, no, you tick that box. Now it's 500 million. Okay, you tick that box. Well, now it's I don't know what. So it just there are all these hurdles that come up. Having said that, we're incredibly grateful for the Emerging Manager of Managers program. Exponents has been a big believer in our firm and has been the ones who've allowed us basically to exist. They've been the ones who funded us 2 years ago, I think. So 3 years into our existence, basically. Then there are other allocators, large allocators who run emerging manager programs, essentially. Now CIOs are starting to pay attention to us as well. So we are grateful for those early adopters. We hope to help them as much as we can and do our part of the bargain. And hopefully they will continue to exist and continue to, invigorate the emerging manager programs and the ecosystem that exists within the space, because it is needed. There's a lot of talent, I think, out there from teams or people who spin out of large firms, and it'd be nice to give them a shot as well, not just the establishment.
That's very interesting. And then in terms of the use of quantitative strategies, so we talked about some of it having a heyday, and it's probably still a little bit beneath the heyday in terms of popularity. What is the use case for quant strategies today? Do you tend to see them put alongside fundamental equity? Do you see them occupying the space that active fundamental would have taken before? Any kind of pattern emerging?
They tend to be more like allocators who believe in quant and allocators who are a little bit suspicious of quant. But generally, the quant has proven its mettle, I think. And there are good days and bad days for quant as well. Like you said, the signals blowing up for fundamental reasons, but fundamental managers suffer from that as well. Usually quants tend to be an anchor in the portfolio, so we view us as being more core. We're core rotational within that core space, but that's the best use, I think, of quant, because we can navigate a little bit the risk dynamic between, where the risks pay off on the slightly growth, slightly value side, or different exposures, whether it's sectors or countries, and, add value through that. So that's usually the applicability of quant. But what's also nice is that, we have a quant model that is global meaning EQI, IMI, and, we launched with 2 strategies, a US microcap and a global strategy. Every other strategy we've had has been at the request of clients. And having a quant model that ports itself to the inefficient areas of the market, but where the client needs a complementary plug, for lack of a better word, that usually is very helpful. And so we've seen, quant models or quants being used that way as well.
It's fascinating. I don't often speak with microcap managers. I think that universe is very limited. And there was one school of thought last time I allocated to them that microcap behaved like a proxy, a liquid proxy for private equity or venture capital investments, given some of the nature of those microcap companies. Of course, more liquid, but, maybe wouldn't behave exactly the same. But I see that link. How would you say microcap as a sector has performed, given how small
Mhm.
cap has perhaps lagged large cap recently?
So we met with a prospect who asked us, how did the microcap go? And it was such a lovely Freudian slip. So the thing about the microcaps or small caps is that the benchmarks themselves, the universe contains a lot of stocks a lot of companies that might not be the best investment opportunities. So there are companies that either have a lot of debt or they have a lot of floating rate debts that can vary quite a bit. They are at the more beginning of their business cycle or towards the end, right, where the microcaps, when they fall down, they trickle down. So there's a lot of selection that needs to be done within that space. The other thing about microcaps and small caps in the US specifically is I think about half the benchmark is biotechs and banks. So regional banks, smaller biotechs. Again, think about the dynamics there. These are very different industries. They suffer from very specific industry-specific issues, right? Whether it's macroeconomic impact on the regional banks or even the biotechs, the fundraising, the cuts we were just talking about earlier, cuts to healthcare funding and the pipeline for drugs and pipeline for many of these things. So those will be impacting these spaces a bit more than a global broad benchmark. So that's, I think it is a proxy for a private equity. I think definitely it's a liquid private equity alternative. To us, it's more there to serve a client need. And from a beta perspective, you want to be balanced out, have some small cap, across the spectrum. I don't think that it's something where I would put a tactical, you want to have just microcaps in your portfolio or small caps. That's your opportunity going forward. It's just because you risk in these markets, as we've seen even, right now, significant periods or regimes where small caps just really suffer because of the wrong environment for small caps, for microcaps. They will suffer the business consequences of what happens at the macroeconomic level far more so than a larger cap that can be more shielded. So yeah, I mean, things being dynamic, just, diversification is still, like they say, the best free lunch, but really understanding how to be diversified across different industries, across different countries, and positioning yourself where that opportunity lies. That's still the best course of action, I think, for allocators and for clients.
This is normally where I ask the diversity question. It seems in the current climate that I'm not sure that's the right question anymore. But one of the questions is, you mentioned emerging manager programs. And I think that's a fascinating area that clearly grew up to meet a need, which was perceived as just the lack of opportunity going to smaller firms. And I talked about barriers to entry earlier. What do you see has been the future of programs like that? Do you think that there's an increased awareness of the edge that smaller managers can bring?
I don't think that the emerging manager programs are restricted to what the DEI, dirty word apparently is. I don't think they're limited to that. It's literally emerging managers. But it gives the opportunity to have people who come from existing firms, or people who have a different idea of investing, to start that business and to basically be able to provide the next generation in investing to existing clients. The key thing here is that it's very difficult within an existing firm, a very large firm, to change the course. It's like changing the course of the Titanic. Once a firm has established, whether it's quant or probably fundamental as well, they've gone to clients for 20, 30 years, they've told clients for 20, 30 years, this is how we do things. So when you come around with a different way of thinking, quite often you just hit the wall and you're told, well, this is not the way we think. Right? And no, we can't do this. And then, they try and make changes. They take that new data set, they take the new model, whatever it is, and at the delta, at the margin, it becomes a slow and, just slight shift, because the bread and butter still has to be what you've told the clients for 20, 30 years that you've been doing. And so that's kind of the difficult part of innovating within an existing large firm. It's standard. I'm not telling you anything here you don't know, that you don't hear in every other industry, right? Innovation is very difficult. But to be able, in the financial industry, in asset management, to be able to allow for new thinking, to allow for new ways of investing, to really break through, you have to create that emerging manager ecosystem. You have to be able to give the new startups a way to flourish and to prove themselves. And that's why the emerging manager space is so important. I was at a number of conferences in February. Actually, they held emerging manager conferences. Several New York plans help them. And it was just a wonderful week where we saw the support of allocators, people saying, we don't back down because we have seen in the numbers, and you're better off getting the numbers straight from them, that the emerging manager space outperform by quite a bit. And so it's nice to see that these programs work as well. It's not DEI. I'm not waiting for a handout. Nobody is. We're just wanting to have an opportunity to be at the starting line. Just being there to be able to make a pitch, to have a chance of being in the running, and then having a chance to run the race let's see who gets there first. Let's see if indeed we can do that. You don't need 200 people. You don't need, again, a lot of the technology that's been around now has really facilitated, especially on the quant space, facilitated the integration of different data, new models. We run everything on the cloud. We have Snowflake, AWS, a lot of integration of really, technologies that facilitate execution. We have models that utilize a tremendous amount of data, so many signals, different models that we employ. It's not been an issue. If you have the know-how, you can go ahead and implement it, right? And the technology is supporting you to do so. But you need to have the allocators, also give you a chance.
It's really interesting the point you make about innovation, because I've been doing a little bit of analysis on what it takes to be truly innovative, and we're comparing finance to technology, where there's kind of a budget almost given for trial and error and failure and innovation, whereas when you're managing somebody else's money, it's much more difficult to have an environment of trial and error. And equally, one thing that I've discovered is feedback is so important to that, developing to knowing what works in an innovative context. I would think quant, given your frequency of trading, perhaps more feedback opportunities. Can you just paint what would be kind of a typical turnover rate, say, in a portfolio, typical number of positions?
Yeah, so for us, it's about 200 to 300%, 250 to 300 per year. So we're not too high frequency. We're not also, very slow. It allows us to adapt to different markets, to different environments. It allows us to refresh the alpha and get different insights into the model. Now, the frequency of trading, the turnover, is dependent based. It's directly linked to your prediction horizon. So if I predict 6 years ahead, then I'm going to have a very different horizon than if I predict for the next week. So it's that horizon, the prediction horizon, that then determines kind of the frequency of trading. And then a mixture of horizons, of course, then there's that balance of where you want to be trading. For us, we think that this kind of turnover, what we've experienced, has allowed us to both incorporate different movements into the markets from a macroeconomic perspective, or different announcements at the stock level. As the markets trades, as the stocks transition, we can capitalize on that.
You use that term prediction. And I think one of the things I've learned, at least in the strategy side of things, investment strategy, is predictions are very, very difficult, particularly today. Has this, you may use it in a different context, prediction horizon, but given and again, you use the term signal and noise, and I would say there's probably more than the usual amount of noise today, as well as just a whole lot more signals.
Yeah.
Is prediction getting more difficult? Do you have to bring your horizon in?
Yeah. Well, we're dealing with two accounts, just as a aside, that we're supposed to transition one of them 2 days ago, right before the tariffs. And so we've been in touch with the client saying, hey, you know what? I know I can predict some things. Then I have some probability of, getting a higher hit rate. And that's what we call by prediction, right? Being the rights versus wrongs. But I don't know of anybody who can predict which way the reaction to the tariffs is going to go. And so can we please just postpone the transition for another, I said 1, 2, 3 days. Let's see what happens. If nothing happens, we'll go right ahead and transition. Otherwise, we'll just figure it out. Well, we're going to delay it now till, for another few days, in the middle of next week, just because you've had one reaction and another reaction. And you see constantly, new macroeconomic announcements around this country saying this, and the market adapts. So yeah, prediction can very much just not work, depending on what is that you're trying to predict. And some of these things, some of these macro announcements, I don't know if a single person can predict them. The markets thought they all incorporated the news around the tariffs. As we've seen in the last couple of days, there's a lot more that has still had to be digested. What we're doing is basically taking risk in. What we're doing is trying to figure out, does the alpha contain that information or not? At the end of the day, I don't want to trade on alpha that does not reflect what's in the market. And if my alpha does reflect what's in the market, then I can trade on it as much as I can. But it's also important that you don't overreact. Again, rebalancing at the bottom of a market reaction, overreaction, or underreaction can lead to you locking in. And then quite often what happens is there's a bounce back, or there's a reaction the other way to get to some equilibrium. And so what I've observed, historically through these periods, high volatility, less trading and more kind of just weather it out, bring in the risk and weather it out tends to be a better strategy than faster trading. You can trade fast once you have the information. If I know that, something has been reflected in the analysts changing their expectations or valuations or earnings or something like that, and I have a new earnings number, I have a new analyst number, obviously I want to incorporate that because I'm not going to bet on the old analyst number. But if I don't have that information, not reacting is the better choice than overreacting or buying into the reaction.
I like that, the lack of action bias there. I'd like to just get to some personal reflections now, just to conclude. So throughout your career, from the PhD work into a large quant firm and now your own, have there been any highs or lows that you can speak to, and any maybe lessons learned from the lows?
Yeah, I think to me the most difficult part has been just navigating motherhood and work. Just being fully honest here, nobody gave me the manual, and it's been a lot harder. Nobody warned me ahead of time, like as often happens with, I think, a lot of, people, you jump into parenthood with 2 feet. That is just a very difficult part of people's lives and women's lives, especially if they want to stay engaged in the workforce. With travel, trying to navigate breastfeeding, little infants, babies, toddlers, whatever it is. And then basically lack of role models. I had to reach out to people outside of the firm I was working in, just be like, hey, how did you pump and bring home the milk? Did you do that? Like, tell me what to do, how to navigate this. So, to me, it's important that you build that network. The big lesson there, I guess, for everyone, for me at least, was just build a network. Have people that you can reach out to, have other like-minded people that have been through these struggles, and just get their perspective. Because you can read online, you can look at things. There isn't one solution fits all, but the more you have a support network that can be there for you, the better off you'll navigate. And nobody can take the hardship away in many ways, right? And there's a lot of beauty in it as well. I look at my kids now, as I mentioned earlier before we started, we're going to the college visits for the next 3 weekends, with my oldest. I can't believe it. Like really, where did the time fly? Because I remember yesterday being pregnant or giving birth and having to deal with all these questions. But time does fly, and you do move on, and you do move past and beyond, and soon they'll be on their way and life goes on. Also, don't give up, I guess, on your career, on your dreams. That's very hard. I think I've met a lot of women who said, yeah, I can't do it with kids. I just, whether it is full-time work or whatever, I just can't. I fully respect that, because it is very difficult. Like I said, it's a very personal decision. Nobody takes the hardship away from you. But if you can stay plugged in, if you can stay somehow engaged, they do leave, the kids, eventually. And it's nice to then continue. And it's nice, I guess, for me, selfishly, to keep having the friends and the people that I know, the women that are incredibly skilled, who don't just drop out because of motherhood, but stay engaged and then continue the workforce. There's a tremendous amount of talent available that I think as a society we need to keep encouraging and keep harnessing.
That's wonderful. And I think we've got a lot into the kind of creed and motto and life wisdom there as well. I just have one question about role models and mentors, because you mentioned not having specific, maybe female role models. Did you have other kind of mentors in your career that were pivotal in maybe shaping your direction?
To me, my biggest role model is my mom. So I shouldn't say I haven't. And she worked, again, this was communist Romania, where you didn't have a choice, right? And I think she would have chosen to work anyway. But she was an economist, and she worked. And in communism, the state raises the kids. They're like shoved into daycare. But she struggled. She went through a lot of hardship and just making it all work. She's been just a tremendous role model for me. But, you move to a different country, you move to a different workplace or different industry, and all of a sudden it's like, well, Mom, whatever you did in communist Romania does not apply to me carrying a breast pump on an airplane. So thank you. Yeah, I know you struggled because, the washing machine didn't work and you couldn't find food to put in the fridge. And those were the struggles of lack of necessities, of lack of resources. And now I have abundance of physical resources, but no time and know how to navigate it all, how to keep all the balls up in the air. So finding your network more like in terms of, you can have role models, people who inspire you, who have been through a lot of hardship, and then finding a network, people who can support you on a day-to-day or just little tactical tidbits or hints or try this, try that, that's kind of important.
I think my last question then actually is going to go back to your mother's roots in communist Romania a little bit, because we all talk about the psychology of money and how the psychology affects us. And having grown up in Ireland, we would have watched the downfall of communist Romania in real time. I'm of that age and generation. Did that sow any seeds of a certain approach to life, to money, to frugality, to abundance that you kind of as a creed or motto have internalized?
I think so. I think very much so. I loved thrifting. It's a word my teenagers use, going to thrift shops. But it's, to me, it's got the ecological appeal as well, where, you reuse gifts, you reuse goods. But it's something that's, I think when I talk to some of my other colleagues or peers or friends who did not grow up with that scarcity mindset, they're like, you can just buy new, I'm like, I know, but I can also reuse it, or I can mend it, I can fix it, I can, make it last. And so there's a very distinct mindset here that I think is still with me. I think it did help. I mean, to me, it's helpful. My kids will have a different perspective because sometimes our budget vacations might not quite align with their friends' vacations. And so there's that, they grow up in a very different world to me. And I see it now. I saw it when I was growing up. It was like the clash of cultures, not just the clash of generations between me and my parents. And now I look at my kids and I'm like, yeah, you're from a different planet. And they're like, yeah, Mom, you're like so from the 18th century, 19th century. To them, I just know nothing, which is again another teenage thing. But I do have a very different mindset. It's helpful, I think, when you do a startup where you have to really do everything by the bootstraps and just, every penny counts. My business partner and I, we funded this, all out of our own money. So it's been difficult. But look, we've made it now. We have close to 550 million in assets raised right now and 6 strategies and 7 performance awards and, So hopefully we'll keep going. But yeah, we couldn't have done it had we come in with the expectations of a big shop. I need this and I need that. And, having the ability to focus on what is really necessary to create the alpha and what you can build, which is a lot, that has come in really, really handy.
That's fascinating, Artemiza. Thank you I think you started with the 3 roots of your own roots, being a mom, mathematics and mountains. And each of those is a massive, that sort of a area within their own right. Mountains, certainly, maths is essentially unlimited. And then I think it's been wonderful to both root that and then talk about the constraints of startup life. And I think it's through some of these constraints that we find the actual resources of our own abundance, because we can be multifaceted. We can be many back office roles all at once. And as you've shown, we can accomplish multiple things in multiple areas. So thank you so much for coming here and sharing some insights on quantitative investing and beyond with us.
Thank you so much for the opportunity. It's been a pleasure.
I'm Aoife David. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts.
This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organisations and affiliations of the host or any guest.